June 26, 1995, the day Barings Bank, a venerable institution that had survived the Napoleonic Wars, the Great Depression, and two world wars, vanished from the City of London in a single spectacular collapse. One man, a 29-year-old trader named Nick Leeson, had hidden a string of unauthorized bets deep within the bank's Singapore office, and when the markets turned against him, his hidden losses exploded into a staggering £827 million, roughly $1.4 billion at the time, wiping out the oldest merchant bank in Britain. To understand how a single rogue trader could bring down a centuries-old firm, we must first travel back to the origins of Barings. Founded in 1762 by Francis Baring, the bank began as a modest trading house dealing in tea, coffee, and spices. Over the next 2 centuries, it evolved into a global powerhouse of merchant banking, financing wars, building railroads, and underwriting the United Kingdom's sovereign debt. By the 1990s, Baring's reputation was built on stability, discretion, and a conservative risk culture that had earned it the nickname, the Bank of the Aristocracy. Yet beneath that polished veneer, the bank was struggling to adapt to a rapidly changing financial landscape. In 1989, Barings appointed a young, ambitious Nick Leeson as a clerk on its futures desk in London. Leeson, a Cambridge graduate with a taste for high-octane trading, quickly proved his talent for speculative bets on the Nikkei index. By 1992, Barings sent him to its fledgling Singapore office to establish a new futures operation in the booming Asian markets. The Singapore desk was given a modest capital allocation, and Leeson was granted an unprecedented level of autonomy. He could trade, settle, and even reconcile his own accounts without independent oversight. Leeson created a secret account, code-named Bearer Account 88,888, to hide losses that resulted from his increasingly aggressive positions. Every time a trade went sour, he would move the deficit into this hidden ledger, masking the true exposure from senior managers back in London. The bank's internal controls were lax, and the culture of deference to senior traders meant that few questioned Leeson's self-reported figures. The allure of rapid profits in a market still reeling from the 1990 Japanese asset bubble made his early successes appear as a miracle, reinforcing the trust placed in him. In early 1995, the tide turned. The Kobe earthquake struck Japan on January 17, sending the Nikkei plunging by more than 6% in a single day. Simultaneously, the Asian financial crisis began to unfold, destabilizing currencies and eroding confidence across the region. Leeson's heavily leveraged short positions on the Japanese stock market, which had previously generated lucrative gains, now ballooned into massive losses. Rather than cutting his positions, he doubled down, hoping a swift market rebound would erase the deficits. By March, the error account had swelled to over £200 million. The bank's senior executives, still oblivious, praised Leeson's exceptional performance and increased his capital allocation. The final blow came on February 26, when a sudden and severe market move erased the remaining buffer. The error account surged past £800 million, a figure that dwarfed Baring's entire capital base. On February 27, the bank's auditors finally uncovered the discrepancy. In a frantic meeting in London, senior partners realized that the institution they had stewarded for over 2 centuries was on the brink of insolvency. On February 28, Barings filed for bankruptcy protection. The news reverberated through the city. Barings Bank collapses, a legend undone by a single trader. The British government intervened, orchestrating a rescue that saw Dutch insurer Ing purchase the bank's viable assets for a symbolic £1, thereby preserving thousands of jobs and preventing a systemic crisis. The Barings name survived, but its legacy was forever tarnished. The legal repercussions for Nick Leeson were swift. In March 1995, he was arrested in Germany while attempting to flee the country. Extradited to Singapore, he faced charges of fraud, forgery, and false accounting. The trial, held at the High Court of Singapore, drew worldwide attention. Leeson's defense argued that he had acted under immense pressure to deliver profits and that the bank's management had failed to enforce proper oversight. Nonetheless, the prosecution presented a mountain of evidence: the hidden error account, forged documents, and internal emails that revealed a clear pattern of deception. On December 20, 1995, Leeson was found guilty on all counts. He received a 6-year prison sentence, of which he served 4 years before being released on parole in 1999. In a televised interview shortly after his conviction, Leeson expressed remorse, stating, "I was a young man who wanted to prove himself, and I let ambition blind me to the responsibility I held." The verdict sent a chilling message through the financial world: no trader, no matter how talented, could operate above the law. The collapse of Barings ignited a sweeping overhaul of risk management practices across the global banking industry. Regulators introduced stricter reporting requirements, mandatory segregation of trading and settlement functions, and real-time monitoring of position limits. The Financial Services Authority, now the Financial Conduct Authority, mandated that banks establish independent risk committees, while the Basel Committee on Banking Supervision reinforced capital adequacy standards to ensure that a single loss could not threaten an institution's solvency. In the years that followed, the term Barings collapse became a cautionary case study taught in business schools worldwide, underscoring the peril of unchecked risk, inadequate supervision, and a culture that rewards profit over prudence. Subscribe to The Verdict for more stories like this.